Welcome to Akilah Waldrond CPA PLLC. For those of you who don't know me, my name is Akilah Waldrond, and I am a North Carolina board certified public accountant. My company is AWCPA. We say that for short instead of saying my full name. Our firm is a tax and advisory firm right here in the local community, serving families and businesses. We serve entrepreneurs, contractors, nonprofits, schools, and families. Anyone who wants clarity around their taxes. We also can consult on structure and growth for businesses, whether it's choosing the right entity type, responding for requests of proposals, or navigating state education credits. We can help you with that. For families, if it's tax strategies around charitable donations, shifting gifts from one year to another, and for both families and businesses, individuals, reducing tax exposure is what we do. We can help you, guide you through the process, and we do all of that with integrity and passion as we strive for excellence. And our mission is simple. We want to help taxpayers keep more of the money they earn. And we do that by combining accurate accounting, strategic tax planning, and real-world business insight so that individuals and companies can make financially confident decisions all year long, not just during tax season. Let me switch this slide. Okay. All right, so what will we be talking about? There's 4 goals that you can look at as we navigate through this webinar. We want to empower you with knowledge. We want to provide a clear roadmap, what that looks like as you engage this firm. We're going to deeply dive into certain tax topics that we think that will be a benefit to you. We're going to talk about some hot topics along the way that concern the One Big Beautiful Act that starts, well, some of it starts in 2025 and some of it starts in 2026. So that will be sprinkled throughout as we go along the webinar. So first, as you know, knowledge is power. To reduce uncertainty and empower you with knowledge, we want to give you a clear roadmap for the upcoming 2025 tax year, or the ending of tax year 2025 into the tax season of 2026. So over the next hour or two, we're going to walk you through most common pain points that we encountered this year. We don't want to revisit the stress, but what we want to do is we want to make it a more seamless process going forward. We want to demystify some of the gray areas, explain the why behind certain decisions and certain questions we had, and show you how we can partner together to make this a more efficient experience, so that we can avoid delays, surprises, and unnecessary tax burdens. We have a couple of weeks left in this year that we can still strategize and use this information to make some strategic decisions. And as you know, those of you that are our clients, we use Drake software. So you may be familiarized with how to go through the Drake portal, but Drake has made some changes. And so we're going to walk you through what changes Drake has made. We're also going to talk about some of the tax concepts, such as selling and purchasing primary residence. The impact of that. We're going to talk about Schedule C in good detail. We're going to talk about Schedule E in good detail. We're also going to talk about education credits, tips and tax on tips and overtime. Fred is going to talk about that with you. We're going to talk about the brokerage statements and estates and trusts. And we're also going to talk about the importance of bookkeeping. So after we finish talking about those topics, we're going to open up the floor at the end for 5 to 10 minutes for questions. We ask that you don't ask questions that are specific to your situation. Try to generalize them because this is an open forum and we don't want your private information out there. The other thing to keep in mind is that while we're giving you powerful information, this information cannot be used for, don't refer to this information for your private use. We want you to connect with one of us so that we can help you apply it to your specific situation, because there is so many nuances and not everybody's situation is the same, but this information is still powerful, okay? Again, we want to educate, equip, and empower you. Taxes shouldn't feel like a guessing game, and we don't want you to feel that way. You are an individual, and we want to make you feel like an individual and not just like a number. So first, we're going to go through the tax engagement. What is it like to go and work with us as a tax firm? So the first step is the 30-minute free consultation. Anybody that's new with us, you get 30 minutes for free, and you can use that time however you see fit. Basically, at the end of that, if you just choose to go with us, then we take you through the next stage, which is to give us your information so that we can set up a portal with us with Drake. Drake uses Secure File Pro, which is a very strong and secure platform where we can exchange information, your private information, back and forth with the firm. Let's see, the next stage after you've given us your private information, we've given you the access to the portal. So this is what the portal would look like. And I think I'm jumping ahead, and let me slow down a little bit to make sure that you are understanding what's happening. So you engage us, you give us your email address, we send you the link to set up your portal. This is where you're going to exchange your information. When you're ready to provide us your information, you would upload it to your portal. You're also going to get a client organizer from us. Now, we need the client organizer to be completely filled out, completely, if anything applies to you. If a certain schedule doesn't apply to you, then you don't need to fill that part out. The problem is we've had client organizers that were incomplete. We didn't have the children's name, date of birth, or social security number. We didn't have the spouse's email address or contact information. We need all of that so that we can have a complete file and then be able to start on your tax return. Also, it serves as a place where you can know exactly what you're giving us. And it helps you to know that, oh, maybe I forgot my dividends, or maybe I forgot my brokerage statement. All right, so please take your time and fill out the client organizer. After you've completed your organizer and you've uploaded your documentation to us, then we are alerted that we have everything that we need and we can start the tax preparation process. So a tax preparer will start on your file. Once they retrieve your documents, they will contact you and make the introduction to you. This tax preparer will be in constant communication with you throughout the preparation process. Once they have completed that process, it alerts us as the reviewer. So I have myself as the reviewer, and then Fred Sarin, who's also a former CPA. He is retired, but he has joined us and he helps me to review the returns. So we review it, we go through it like a fine-tooth comb, and then once we're done with our review process, we notify the client. Once the client gets the draft, they hopefully, I would advise that you look through the draft. It is so important that you make sure that we did not forget anything, that there's no typos, that your address, if you changed your address, we put in your new address. If you have an additional child, we added your additional child. Make sure that we didn't miss anything. Then you get the opportunity to approve the return. And you can do all of this through the Drake portal, by the way. So you approve the return. Once you've approved the return, we get notification that you approved it. And then the front desk, then what they will do is they will send you the documentation that requires your signature and the invoice to pay for our services. So once you have signed and once you have paid, that's when we electronically file your return. We typically get an immediate response from the IRS, but the state is not that quick. So we don't want to send you that we've got the approval until we get their approval from both entities or from all tax agencies in the case if you have multiple states that we're filing a return for. Once we get all of the acknowledgments, the front desk will notify you and let you know that your completed return, your filed return is in your portal. Be advised that if you have taxes that are due and you opted not to pay it with the filing of your return, that there will be vouchers also included. Please don't forget to get the vouchers and make the payment to the appropriate agencies. We want to emphasize this because there was a lot of times where the vouchers wouldn't be pulled down and taxes wasn't paid, and then you got a notice from the IRS. So please, we want to make sure the purpose of this webinar is to help you to remind you and to emphasize the point of the client organizer, because if the client organizer is complete, then there won't be any of these issues, because we will know that you want the taxes that are due, you want them drafted, or you want to use a check. So once this is complete, then you are good to go. Now, there will be times where you have dropped off your documentation. If you've dropped off your documentation, please be sure to come and pick it back up once the tax preparation is complete. So next, we're going to go into the video presentation from Drake. And then once that is done, Sean is going to pick up, who is the moderator, and he will continue to facilitate the webinar from that phase. So stand by as I pull up the video.
Drake Portals continues to simplify how your clients connect with your firm, securely, quickly, and now with a modernized, more intuitive experience. With over 1 million taxpayers using Drake Portals each year, this update supports faster collaboration between you and your clients, improving visibility, reducing questions and delays, and helping you stay in sync. Clients are greeted with a clean, redesigned homepage, including a live return status bar, which can be disabled by the preparer, and a personalized list of tasks, so your client always knows the next step. All to-do items are now combined on a single page, So confirming profiles, uploading files, signing returns, and approving forms is simpler than ever. You can now request client approval for files uploaded through Drake portals, and your clients can quickly review, approve, or reject them, keeping everyone on the same page. Clients can securely sign their returns with no extra software, and each action syncs instantly with your preparer dashboard. The enhanced checklist gives your clients a clear view of what's needed, from uploading. And now, they can link previously uploaded files to checklist items, keeping data collection simple, streamlined, and free of duplicates. And it's just as intuitive on mobile, from uploading to signing with a fingertip. For tax professionals, the experience is more connected, with powerful tools to track and manage your clients' next steps. Drake Portals now works even more seamlessly with your favorite tools, including Drake Workflow, eSign, and Drake Pay, so you can manage client interactions, tasks, and payments all in one place. Together, these updates drive more client adoption, fewer delays, and a more efficient firm.
Good afternoon. My name is Sean Stanley. I'm a tax preparer here at Akilah Waldrond CPA PLLC, and I will be your moderator for today's webinar. And we are just so grateful that you've taken the time out to join us today to get a good, fresh piece of information on getting your 2025 tax returns prepared. We're excited to provide our expertise to assist you in that smooth endeavor of filing your 2025 tax return in this 2026 tax season. So at this point, we're going to move right along and we're going to start with our first presenters, and they're going to be presenting on the purchase and the sale of home, and that'll be conducted by Fred Saran and Noma Uzazi.
Hi, I'm Fred, and I'm going to start this off, and we're going to talk about the purchase and sale of a home. For most of us, the purchase and the sale of your house is the largest single financial transaction that you will do in your lifetime. It's sometimes frightening, very happy, sometimes sad. I lived in a house for 40 years. It was sad when I had to sell it. But there's a lot of things that go into the purchasing and the sale of the house. For a quick introduction to the type of properties, let me flip it over to Noma.
Hi, everyone. My name is Nama Uzazi. I am a tax preparer here at AWCPA, and I will be talking on the types of properties. So we have two types of properties: residential property and rental property. Residential property is the primary home or vacation residence that is not intended to produce income, while your rental property is used to generate rental income and is treated as a business/investment asset. So for these purposes of this webinar, we're going to be focused on residential properties. So I'm going to pass it back to Fred, and he's going to be showing us an example of what the settlement sheet looks like. Thank you.
Okay. The first thing we're going to look at is the purchase of the home, which is the natural. That's the first thing you do. The copy that you see there is called a HUD form, Housing and Urban Development. It is probably the most common form of settlement sheet. If you look at it, you can see on the left side is the purchaser, or they're referred to as the borrower, because usually most of us, when we purchase, we got to borrow. And then the right side is for the seller. We're going to focus on the purchase. There's a lot of things on here. I'm not going to go into great detail on it, but there are important things to note on this. Obviously, the price of the house, the mortgage that you're going to be taking into it, some tax items, and what that house stands you after you purchase it. If we go to the next slide, it's going to show you the second page of the settlement sheet, but more importantly, we're going to look at a spreadsheet. Yes, folks, we are accountants, and spreadsheets are our life. We do so many things with them, and one of the things we do here is to summarize what the purchase is. You'll see there are 3 columns of numbers. The one on the extreme left is the actual purchase price. The middle is your settlement expenses. And the last one is other items. Why this is important is when you buy your house, for example, in this case for $290,000, your house cost you more to purchase that. That middle column, settlement expenses, needs to be added to that purchase price so that on day one, your house stands you the $290 plus these settlement expenses. Very importantly, on the further right column are other items. Some of those are your loans, some of our due diligence, and that people always say, what is due diligence? Well, when you are purchasing a house, most of the time the seller says, if you're really interested and you want to go through with this, we want you to sign an agreement, pay us some money, and go ahead and arrange for your financing. And that's what the due diligence is. There's also other things on there that affect your first year purchase tax information. I've highlighted those. One is real estate taxes. You're not going to see this number anywhere. It's the amount of real estate taxes that you had to pay or reimburse somebody for when you purchase. There are 2 other items that are points and interest. These items all, most of the time, I'd say 99% of the time, will be picked up by your mortgage holder when they send you at the end of the year a Form 1098, which will tell you what your mortgage is, what your interest is, what the points are paid, and points are deductible. So that's the other things that are in there is items of escrow. I'm going to now skip to the next slide, which is the sale of the house. Sale of the house, it shows you an example of another settlement sheet. This is not a HUD settlement sheet. There's no legal requirement to use the HUD settlement sheet, but this is a different form of it. This basically is saying what you've sold, what's your cost of selling, and I'm not going to go again into great detail, but you sold it for a certain price. You had settlement expenses or basically closing costs, most of which are commissions. You got to pay your real estate agent for selling the house. There are also other transfer documents like title, some home warranty, some property taxes as well enter into it. Again, on the next sheet, you will see, again, this spreadsheet where we do have our selling price, settlement expenses, or sometimes referred to as selling expenses, and other items, again, taxes and additional taxes, which will be picked up on your tax return. One thing to note, you're selling your house. You may have purchased it 20 years ago. It's very important that you keep track of these records. If you sold your house, we're going to ask you, what'd you purchase it for? If you haven't saved your settlement sheet on your purchase, it's going to be hard for you to know exactly what you did. So we want you to set up a folder. Just call it your house. And in there, you put your original purchase settlement sheets, and very importantly, receipts for additions to your house. Because if you've put on a deck, you put on in a fence, if you added on a room, if you had to put a new HVAC system in, those are items that are going to add to the purchase price so that when you sell it, we can accurately take and calculate the gain on the house. And real quickly, if you're single and you've lived in the house for the last 2 out of the 5 years, you can exclude $250,000 of the gain. And those of you that have owned homes prior to 2019, most of you have got nice gains. And if you're married filing jointly, you can exclude $500,000. That's a pretty nice deal to have. So that's why it's important for us to accumulate all the costs. And so when we hound you, we're going to ask you, please think about it. What have you done to the house? And I don't mean, well, we had to fix the refrigerator. That's a repair. We're talking permanent additions.
Thank you for that information, Fred. That was excellent. Just want to reiterate, he brought some things out about the documentation. In this day of electronics, you can also electronically keep copies of your documents and keep them on your computer systems. That's a great way of keeping it where you can reduce the paper in your house. If you're like me, I'm a pack rat. I collect everything. So I try and do a lot electronically these days so I don't get in trouble by the missus. Next, we're going to move forward and we're going to talk about home office and depreciation that's reported on Schedule C. So you entrepreneurs, listen up.
Hello,
Go for it.
everyone. Hello, everyone. Thank you for being here with us today. My name is Heba. I'm a tax preparer and enrolled agent at Akilah Waldrond CPA. Today, I will walk you through the Schedule C home office deduction and the vehicle expense deduction. Let's start with the first slide, provides us Schedule C. I'm going to talk about Schedule C, home office deduction and depreciation, and the vehicle treatment. Okay, let's start here. This slide provides a high-level overview of Schedule C, which is used by solely proprietorship or a self-employed individual to report their business income and the expenses as a part of their Form 1040. Schedule C structure is a key component of the business, includes the gross receipt, the cost of goods sold, deductible operating expenses such as advertising, utilities, and professional fees. This affecting your taxable income and self-employment tax, making accuracy essential to avoid any penalties. Some of the most common mistakes we see here, missing receipts, mixing personal and business expenses, or incomplete information, which that slow down your preparation process and may limit your valid deductions. Understanding how the Schedule C works, a Schedule C works helps ensure accurate reporting and a smoother tax filing experience. This slide gonna introduce for you the depreciation means, which allow the business owner to deduct the cost of certain assets over their useful life rather than expenses them all at once. The assets that commonly qualify for that depreciation include the office furniture, equipment, or in the vehicle that used in the business because these assets are used over multiple years. The IRS required the cost to be spread out. So accurate record keeping is essential, such as purchase dates, cost, and business use percentage must be documented to support these deductions. So the IRS uses methods such as makers to determine the recovery period, and following these guidelines helps avoid disallowed deduction or penalties. When the depreciation is applied correctly, it can significantly reduce your taxable income while keeping the return fully correct. The vehicle has a special tax rule, and this is an area where mistakes are very common. Business owner must choose between two. Number one, the standard mileage method or the actual expense with a depreciation. And once a method is selected, it generally cannot switch to the other one next year. Because of that, documentation is very critical, and you should always keep purchase receipt, mileage logs, business use percentage records, and proof of the payment. Without correct record, the IRS can disallow vehicle deduction completely. So strong record keeping not only protect the deduction, but also makes the tax preparation process smoother and reduce the risk if the IRS ever asks for documentation. This slide, I'm going to explain the home office deduction, who qualifies in what does it qualify and what type of the home office deduction. It's two ways to write off the home office deduction. Number one, simplified deduction or actual expense. To qualify, what is the home office deduction? A tax benefit for using a part of your home for your home exclusively used for the business. Who qualify and who doesn't qualify? You are qualified if the business used regularly and exclusively for the business and must be your principal place to run the business. Unfortunately, using the kitchen table or sharing space used for personal purpose doesn't qualify for that deduction. But here a point, however, if you are using a big room and using a part of that big room for the business, you still eligible to write off the portion that only related to the business. When that requirement are met, the home office deduction can help you offset expenses such as a portion of your rent or utilities or insurance. So understanding the rules helps avoid common mistakes, ensure that deduction is plainly corrected. So type of the home office deduction is 2, simplified deduction or actual method. Simplified deduction is $5 per square feet up to 300 square feet. The actual method, you're gonna write off mortgage, interest, rent, utilities, insurance, repair, and depreciation that only related to your business portion. This slide, we're looking at the Schedule C in our client organizer. This section is it's very important for anyone who is self-employed, freelancer, or small business owner. This organizer is to be a mirror for your actual IRS Schedule C, which helps you ensure that we gather complete and accurate information before preparing your tax return. In this section, clients are asked to provide basic business information, such as the type of the business, account method, and whether there is any major changes happen during the year. You also see areas like gross income, including sales, other income, followed by breakdown of the business expenses like advertising, office expense, vehicle cost, or insurance. On the right side of that organizer, we will cover the auto expense and the home office deduction. This is why it's so important to complete this organizer carefully. Incomplete or estimated information can lead you to miss deduction. Our goal with this organizer is not just collect number, but to tell you the full history of the business. We can maximize allowable deduction. Taking the time to complete that section helps us to prepare a clean, accurate Schedule C and results in a smoother tax filing process for everyone. So here's a summary. Maintaining detailed income and expense record, simplify the tax preparation, reduce your errors for self-employed individual, and also avoid any common IRS red flags, include like very high deduction, unreported income, or missing supporting document. Using your accounting software or spreadsheet helps track transaction and keep the receipt organized for deductions. Consult us anytime. We can help you better planning and reduce the stress during the tax season. Thank you.
Thank you, Heather, for that wonderful presentation. At this time, we're going to get ready to take a break. But before we go to break, I just want to remind people that if you have any questions, we're going to cover it at the end. But with your questions, we don't want you to make them too personal because, there are other people here listening and we don't want to put your business out on the street. So welcome back. We hope that you have obtained some good information in the first portion of our webinar. The presenters provided a lot of detailed information. So we're going to move forward and provide you with more information. We're going to have our founder and owner of Akilah Waldrond CPA PLLC come and talk to you about home office and depreciation for rentals and K1s that are reported on the Schedules E. Go ahead, Akilah, take it away.
Hi again. Thank you, Sean. You're such a wonderful moderator. I'm not going to be talking about home office, but I will be talking about Schedule E. I did want to say one thing before I moved into the Schedule E, is that under the One Big Beautiful Bill Act, Did you guys know that President Trump has made permanent bonus depreciation at 100%? So if you purchased a vehicle or any sort of investment that is 20 years or less, that you can take 100% bonus depreciation. So if you purchased it after January 19th of this year, you can claim it. So that includes vehicles, that includes certain property, machinery, equipment, 100% bonus depreciation. So I just wanted to make sure that I let you know about that. There are also other things, special Section 179 depreciation. There's some good news there as well. But moving to Schedule E. Schedule E is where we report rental activity. And I know that Heba said that rental is like a business. It is, but it's not, because of the fact that it is a passive activity, unless you're a real estate agent or you're in the real estate industry in terms of being 100% of the time. So in other words, in order for you to qualify as a real estate professional, you have to have 750 active hours. So you probably aren't, and it's probably passive to you. So we report rental activity on Schedule E, but we also report royalties on Schedule E. You'll also see if you're a partner in a partnership, you'll get a K-1. That's reported on Schedule E. If you are a beneficiary of a fiduciary return, those get reported on Schedule E. And if you are an owner or a shareholder of an S corporation, that information gets reported on Schedule E. So I'm going to talk about rental activity. I'm going to kind of focus in on that a little bit because that's usually what we see as far as being reported on Schedule E. So it's still like a business. You still have to track your expenses. You still have to track your miles. You know, please keep track of your repairs and improvements. And you also get to claim depreciation. So it's important to know how much you received in rent income on that property. By the way, security deposits that you receive, that is not income. That is supposed to go into a separate account and earn interest. Okay. So don't treat it's not income. But you know, generally speaking, security deposits are used if it's included in the lease agreement to be used to repair the property or whatever happened while they were in the property, and then they get the balance back. So it's security. It's like you're being a trust. You're holding in trust the client's information or the client's security. Mortgage interest you get to claim on Schedule E. Property taxes, homeowners association fees, any utilities that you've paid. And by the way, if you've rented the property long-term and let's say in June they move out and you didn't find anybody in July and August, but then you found somebody in September, July and August, you probably had to pay utilities. And by the way, as long as it's out on the market, you get to claim that expense. Okay, don't get confused because you didn't have anybody in the property. You didn't move back in the property, did you? Unless you move back in, then we need to worry about some things. Repairs versus improvements. We see confusion around this because there's special tax rules that we have to be careful about. Don't send to us that you spent $4,000 on general repairs. That's not going to mean anything to us. We're not going to know what to do with that. We need to see the receipt. And we need to understand what was happening here. Did you repaint the property? Did you paint it on the outside? Did you repair some floors? Because some things have to be capitalized and recovered over time. If it's under 2,500, then we may be able to expense it. So please be careful and detailed about some of the things that happen, especially when it comes to repairs versus improvements. This gets confused. And if you added a debt, like Fred said earlier, but you added it to the rental property, that's good. But that's not an immediate expense. That has to be recovered over 27 and a half years if that's residential property. All right. So, I've slowed down because I wanted to make sure to focus in on repairs and improvements. But one of the other biggest the things that you get to claim on residential rental property is depreciation. And so don't get don't get upset or concerned that we're asking for the the closing disclosure on the purchase of the property. We need to know how much you purchased the property for so that we can properly claim the depreciation on it. So I have to end here, but again, next week we have the open house. If you have specific questions concerning your issue, don't hesitate. We can help you out there. It's still we got time before the end of the year, but take advantage of that next week because the holidays are rolling. The next year will be over. So we'll be into the new year. All right. So again, thank you for your time here. And I'm going to move the floor right back over to Sean. Thank you.
Thank you for that wonderful presentation. I hope everybody got some information out of it because I certainly did. And I saw that one of the keys, again, is record keeping. You must maintain your records. So moving right along, we're going to go into the education credits and student loans. And the presenter for this presentation happens to be my office suite mate. So Connie Zhang, take it away.
Hello, everyone. Thank you for joining today's webinar. My name is Connie Zhang, and I'm a tax preparer at AWCPA. Before moving here from Canada, I worked for the CRA, Canada Revenue Agency. And today, I'm excited to walk you through two powerful tax benefits that can directly reduce your tax bill and increase your refund: education credits and student loan benefits. Let's begin with education credits. The first and most valuable education benefit is AOTC, American Opportunity Tax Credit. AOTC applies to qualified education expense paid for an eligible student during the first 4 years of post-secondary education. Here's what makes the AOTC so beneficial. It covers tuition, required fees, and course materials. It is worth up to $2,500 per eligible student. And most importantly, 40% of the credit, up to $1,000, is refundable. That means even if you owe no tax, you can still receive up to $1,000 back. The second credit is the LLC, Lifetime Learning Credit. LLC credit is more flexible and can be used for undergraduate courses, graduate programs, professional development, or job skill courses. There is no limit on the number of years you can claim it. It is worth up to $2,000 per tax return. Okay, let's go. Why this matters? Education credits can save families thousands in taxes. The AOTC can even provide a refund for those who owe nothing. Your MAGI, modified adjusted gross income, must be under 90,000 single or under 180,000 if married filing joint. Above these limits, the education credit is not allowed. However, unlike the AOTC, the LLC credit is not refundable. Our priority is to make sure you receive every dollar of tax benefits you qualify for. To do this, we complete all required IRS due diligence requirements. Decide whether the parent or the student gets the greater tax advantage. Prepare your return in a way that protects you in case of any IRS review or audit. We rely on Form 1098-T, tuition statement, to do this accurately. Our goal is to maximize your refund, ensure you qualify, protect your eligibility, and support you if the IRS ever questions your credit. Now let's shift to student loan interest. The IRS allows deducting up to $2,500 of interest paid in 2024. If your MAGI is less than 95,000 single or 195,000 if filing a joint return in 2024, you may be allowed a special deduction for paying interest or a student loan. Please upload Form 1098-E Student Loan Interest Statement. This credit and deduction can make a meaningful financial difference for students and families, and we are here to ensure the process is simple, secure, and as beneficial as possible. Even if you didn't receive a statement, you may still qualify if the fees were paid. So please let us know, and we will be happy to review it for you. You may receive several emails requesting tax information or statements. We ask for your patience, as this helps us make sure no benefit you are entitled to is overlooked. We truly appreciate your cooperation, and it is always a pleasure working with you. Thank you.
That was very good. I enjoyed that presentation because I happen to have a college student and I take advantage of that interest expense. Next, you get to hear me. A little bit about me. I'm a retired special agent from the Department of Justice. I'm in the same realm as Fred. I'm a retiree, but I decided to come back to work. So today I'm going to present to you a little bit of information regarding the standard deduction versus itemizing deductions. Standard deductions are a fixed dollar amount set by the IRS that reduces the portion of your income subject to federal income tax. So no, we don't come up with the standard deduction. The government provides it to us. The standard deduction is a flat dollar reduction in taxable income available to most taxpayers. Instead of itemizing individual expenses like medical bills or charitable donations, you can take the standard deduction to automatically lower your taxable income. The standard deduction makes filing simpler and often results in savings, especially for people without enough deductions to justify itemizing. The amount of the standard deduction, the IRS updates the standard deduction amounts every year to keep pace with inflation. It makes these adjustments to protect taxpayers from cost of living increases. The updates also help seniors and their families better anticipate their taxable income from year to year. Just some facts about the standard deduction. It is not a one-size-fits-all figure. It depends on your filing status, such as single, married filing jointly, head of household, or married filing separately. Each status has its own base deduction amount, with married couples generally receiving the largest benefit. So it does pay to be married. Seniors over 65 are eligible for an additional amount on top of these figures. This eases their tax burden as income often shifts in retirement. Let's talk about the standard deduction for seniors. Seniors over 65 are eligible for an additional amount on top of the standard deduction. This eases their tax burden as income often shifts in retirement. The extra deduction for older taxpayers recognizes that retirees often have fixed income sources, such as Social Security or pensions. By reducing taxable income further, the government aims to help seniors preserve more of their financial resources. This benefit can be especially impactful for seniors balancing healthcare costs, retirement savings, and day-to-day living expenses. There's an additional bonus deduction for us seniors. Beginning in 2025, some seniors may also qualify for an additional $6,000 bonus deduction, depending on your income level. We would determine that eligibility based on your date of birth if we do your returns. Accurate filing is a must in this area. A wrong birth date or unchecked box could cause you to miss out on hundreds or even thousands of dollars in tax savings. We recommend working with the qualified tax professional, such as Akilah Waldrond CPA, to help ensure you maximize your return. Let's just look at the current standard deduction amounts. The single and married filing separately is $15,750 deduction. The married filing jointly is $31,500. The head of household is $23,625 deduction, and additional amounts for ages 65 plus or blindness range from $1,500 to $4,000, depending on your filing status and conditions. Now let's look at when itemizing could save you more. The standard deduction is the simpler choice for most taxpayers, but there are situations where itemizing deductions can lend to a lower tax bill. For example, high mortgage and property costs. That usually includes things like paying points, mortgage interest expense, and things of that nature. Then you have the SALT deduction, large state and local taxes. We'll talk a little bit more about that in my next part of the presentation. Then you have substantial charitable contributions. And then you have major medical expenses, along with casualty or theft losses. These all can be used to reduce your income. Let's talk about the federal deduction for SALT. Simply define state and local taxes. I know you hear a lot about this if you're watching business news. They've been talking about legislation and doing, increasing the SALT amounts. So for this year, available to taxpayers who itemize expenses on Schedule A of that Form 1040, taxpayers who pay substantial state and local taxes may find that itemizing offers more value. Although the federal deduction for SALT is capped at $40,000 for married filing jointly and single $20,000 or for married filing separately. The increased SALT deduction includes an income-based phase-out, which features and is reduced by 30% of modified adjusted gross income. For modified adjusted gross income levels exceeding the threshold amounts of $500,000 for married filing jointly and single taxpayers, and $250,000 for married filing separately taxpayers for 2025. I want to also emphasize educator expenses. Yes, you teachers get a little expense extra to reduce your income levels. Eligible educators are from teachers from kindergarten to grade 12, instructors, counselors, principals, or aides in school for at least 900 hours, during a school year. Qualified expenses include ordinary and necessary expenses, which are paid in connection with books, supplies, equipment, including computer equipment, software, and services, and other materials used in the classroom. Just a little information additional that with these educator expenses, ordinary and necessary expenses, you may hear those phrases thrown around. An ordinary expense is one that is common and accepted in the educational field. A necessary expense is one that is helpful and appropriate for your profession as an educator. An expense doesn't have to be required to be considered necessary. Qualified expenses also include those expenses you incur while participating in professional development courses related to the curriculum in which you provide instruction. It also includes those expenses related to those students for whom you provide that instruction. Qualified expenses don't include expenses for homeschooling or for non-athletic supplies for courses in health or physical education. Now, there are some circumstances when people are required to itemize. Certain taxpayers are required to itemize. For example, if you're married but file separately and your spouse itemizes deductions, you must also do the same. Also, for non-resident aliens and individuals filing of a period of less than 12 months due to a change in accounting periods cannot take the standard deduction, so they are required to itemize. Just to go over some key points about the standard deduction, it lowers your taxable income, which reduces the amount tax you owe. You can take the standard deduction unless you choose to itemize deductions. It varies by filing status, single, married, filing jointly, head of household, and is adjusted annually for inflation. Extra amounts apply if you are 65 or older or blind. And regarding dependents, if someone can claim you as a dependent, your standard deduction is limited. So in conclusion, we will recommend itemizing deductions instead of taking the standard deduction when the total of your allowable itemized expenses are greater than the standard deduction for your filing status. Thank you. Now, at this time, we're going to move forward and we're going to go to our next presenter, who is Fred Saran, and he's going to talk to you about the new laws regarding tips and overtime. Take it away, Fred.
Thank you. Back again. Probably when this new bill was being discussed in the press and wherever, probably the two most talked about topics were excluding tip income and excluding overtime. And yeah, in fact, when the bill was passed, there are exclusions for both of these items, but they're not quite what everybody was hoping they would be: all your tips, all your overtime. So let's get into, I hate to say this, into the weeds a little bit and talk about what is allowed. For tips, it has to be a qualified tip. And this is an important concept. I know a lot of you have gone to restaurants, for example, and especially if you're there with a whole big group of people, you'll get the bill, and the bill will have tips added on. They may call it a service charge or a service fee, or you're too big, so here's what we want to charge you extra for. It is a tip, but it's not voluntary. You got to pay it. And that is not excluded. You'll not be able to exclude that from your taxes. The other one, and this one strikes really hard for me, customarily received in an approved business. Now, you got to understand, I grew up in New York, and in New York, you tip everybody. Okay? Everybody that you see that does something, you tip. If you want to get an idea about it, look at the movie My Blue Heaven with Steve Martin. He's tipping the FBI agent who arrested him. Sean, I'm sure you would enjoy that. So what is an approved business? Well, on the next slide, which we're not going to jump to right now, I'm going to go over a list of those. But what can you deduct? you can deduct up to $25,000 a year. And that is only in this new law for 2025 through 2028. As with almost every law, it could be changed, it could be extended, or what have you. I'm not going to go over the income limitations. Suffice to say that if you're a very high income person, you may be limited to the amount that you can exclude, including not excluding anything. Also, be careful. You're only excluding it from your federal income taxes. You still are going to be subject to your Social Security, FICA tax, and the Medicare tax on those items. Also, they've put into this, and you're going to see this as well in overtime, you must have a Social Security number. And if you're married, you must file a joint return. So married filing separate, you can't exclude anything. And Social Security number, I think they're probably trying to get at people who are not here appropriately. Now, let's flip to the next slide. And we're going to look at what like common jobs. And by the way, every week, we keep seeing new jobs, specific jobs are being added to this. I got to put my glasses on because I can't read this anymore. We've got to look at these are the most common ones. And you're going to understand it, beverage and food, your waiters, wait staff. The one I found interesting is entertainment and was gambling and magician. So you could tip your magician for causing you to win at your gambling. The other one, which is not as commonly thought, again, from New York, I always thought you did. You tipped handyman or painters in your house, and that is included. And you can look at the list and see that, and probably reading in the newspapers, but that's what you come to us for. We keep abreast of all the jobs that you do that are going to be included in this. Let's skip now to overtime. Oh, yeah. I'm going to get to this additional information because it's going to apply to overtime as well. So let's just skip this right now and go right to overtime. For overtime, again, not all overtime is going to be excluded, but it's the overtime that is considered more than your regular rate. That means if you earn $10 an hour and you spend an hour overtime, you're going to be paid the normal time and a half, $15 an hour. Only the $5, only the halftime is excluded. It's really, really important. Also, there are some people, those are nice people, that pay some people extra double time for holidays or weekends. Again, only the halftime is excluded. You can read some of these things, exempt workers, not exempt workers. And again, we can help you figure out if you're going to be included on that. Once again, it only applies to federal taxes. FICA and Medicare is not excluded on this. Now, the deduction, just like tips, is 25 to 28. You can deduct up single $12,500 a year or $25,000 a year married jointly, and that's per tax return. So if you have a couple that each earn 20,000, only 25,000, not the whole 40,000. Once again, a Social Security number. They want you to file married jointly. And now I'm going to get to what was on the other slide. We don't have to go back to that. I think I remember what it is. These are transitional rules. The bill was passed in the middle of the year. Oh, thank you, Sean. That was great. These were transitional rules because it was done in the middle of the year. And payroll people for overtime didn't have enough time to do it. W-2s and 1099s were already in their printing state, so there was not enough fields to put into it. So IRS said, okay, for 2025 and 25 only, we're going to give you some transitional rules. We're not going to penalize you for not reporting this properly because we understand it's going to be difficult. And this is the one that is kind of strange. They even say, hey, you can approximate what you think the cash tips were or approximate what you think your overtime is, and good luck. You come to us, we can maybe help you figure some of this out. There are ways to sort of back into these numbers. so you don't do something that is silly. Because the last thing we want to do is make you do something silly. And that's it, folks.
Thank you so much for that information regarding tips and overtime. I have a slight tip for you as well. Use Akilah Waldrond CPA PLLC for your tax services in 2026. Are those bells I hear ringing? Wow, guess what we have? We have some promotions for you. It's the Christmas spirit. For signing up for today's webinar, you will receive a coupon code for a $24 discount on tax services. 25. Oh, she went up $1 for me. $25 discount on tax services only if you come to us in 2026 and have us prepare your tax returns. Also, we've also got a 10% discount on tax services if you have served this country as a service member in the military, or you're a U.S. military vet, or a first responder, which includes police, fire, ambulance. We have your name and email address already, so we will send you the coupon code in that manner. Just another quick reminder, when you get your engagement letter, there's this thing called a client organizer that comes with it. Please, it will fill it out because it will contribute to the efficient preparation of your return. It also will ensure you don't overlook any eligible deductions. So at this time, we're going to allow you to go stretch your legs, get a coffee or tea and some water, refresh your palate as we move into a break, and we'll come back and we'll wind things up with the presentations. Welcome back. I hope you have been getting some real good information in the previous presentations. Just a quick footnote regarding the educator expenses that unreimbursed up to $300, but you can also itemize classroom expenses on your itemized deductions too on the 1040 Schedule A. We're going to move forward with 4 more topics to talk about, then we'll open up the room for questions. So hang in there. I hope you still got your coffee and tea. Just take a sip as we move forward to our next presenter, who is going to be Akilah, who's going to talk about estimated taxes.
Thank you, Sean, and hello again. Estimated taxes. Well, what are estimated taxes? Estimated taxes are taxes that we estimate because you don't withhold during the year or you don't withhold enough. Every year we see taxpayers completely surprised by a balance due in April, even though they might say, we had good withholding. What's good? You know? And the reason is simple. If you have income where taxes aren't automatically withheld, the IRS expects you to pay taxes as you earn money. And you'll usually see this with Schedule C filers, those people that receive 1099 NECs. Sometimes you'll see it with partnerships and S corporations. But basically, the bottom line is that you're not paying taxes enough throughout the year. So you need to be on a schedule, and we can help you and put you on an estimated tax schedule. The bottom line is this too. If you are expected to owe $1,000 at the end of the year, then the IRS expects you to make estimated tax payments. I keep saying the bottom line, I'm sorry, because the IRS, they want their money as you earn it. They don't want to wait until April the 15th. And they are cracking down on estimated taxpayers because, a lot of people wait until the end of the year and then want to pay one lump sum. The IRS doesn't like that. They want it April the 15th. They want it June the 15th. September the 15th, and then January the 15th of the following year. So that's the schedule of the estimated tax payments. There is a safe harbor rule. The safe harbor rule, and that will keep you from being penalized, is if you pay 90% of what you think you'll owe in 2025, for example. If you want to pay 100% of what you paid last year, that will also keep you from being penalized. If your adjusted gross income is over 150,000 this year, then you need to pay 110% of what you paid last year to avoid being penalized. Well, what is the penalty? What's the big deal about the penalty? I don't like it because they break the penalty into those quarters. So if you in June 15th, you pay the first and the second payment, the IRS is going to go back and penalize you for not paying what they're going to estimate what you should have paid, and they're going to put a penalty, they're going to tack on a penalty and interest based on what they estimate that you should have paid. Why give the IRS that much power? We are telling you and empowering you so that now you know what to do. And we help with that, especially since we do your taxes. If you hire us to do your taxes, we can put you on an estimated schedule to help you not be penalized up the wazoo, because that's what the IRS, they are really cracking down on it. It came down the pipeline from the IRS that they're focusing on this. So please, don't guess, don't avoid it, and then at the end of the year, pay a lump sum. Don't do that. So common mistakes that we've seen are, and sometimes the W-2 wage earners are not withholding enough. They've completed the W-4 incorrectly. We have two spouses working, and then you might have two kids, and then both of them are claiming two allowances. You're over claiming the allowances, which means that you're under withholding. We can help you make sure that your W-4 is correct. Send us your pay stub and, engage us, and we can help you make sure that you're withholding enough throughout the year. So to set up the estimated tax payments for you properly, just so you know what we'll need to know what your income expectations are this year. Do you plan on selling any assets? Because by the way, if you're planning on selling investment property, or if you're planning on selling stocks, or if you've already sold stocks or sold investment property and you have a capital gain, you probably need to let your tax advisor know that you've done that, and you will need to make an estimated tax payment. The final estimated tax payment is January 15th of the following year. And hopefully the IRS doesn't examine you and say, oh, you sold the house in June. Well, if you sold the investment property in June, that estimated tax payment was due in September. So yes, we can help you with estimated taxes. We can help you avoid penalties. Just let us know. With estimated tax payments, you can get ahead of the IRS instead of the IRS trying to catch up with you. Thank you. And I'm going to turn the floor back over to you, Sean.
Thank you so much for that information. We're going to move right along. And now we're going to have Fred Saran. He's going to present on two different topics. First, he's going to be talking about reporting sales on brokerage statements. Then he's going to come back and he's going to talk about the estate and trust overview and what it relates to the tax situations. Take it away, Fred.
Welcome back, everybody. We keep telling you about documentation and things we need to keep. One of the things that we need you to send to us is your year-end broker reports. So many of you are with Charles Schwab, Fidelity, Morgan Stanley. There's a whole list of them. They send you these voluminous reports at the end of the year, in addition to the monthly reports. They're called year-end tax reporting. Some of them could be 40, 50 pages long. And I know that's a lot of stuff to scan and send to us, but we really need to look at the whole thing. We have seen where people just show us the first page, and that doesn't give us all the detail we need to be able to take advantage of the things that are required. The year-end broker report is going to show you what your dividends, what your interest, what your royalties are, all sorts of other things. But one of the most important thing is the 1099-B part of it, which is the proceeds from your stock transactions. They'll usually give you in the first page or two a summary for the whole year of all your short-term and all your long-term security sales. And they'll also break it down by covered and non-covered and your basis and whatever. And again, we're not going to get into all the details of that, but you can use the summary. We use the summary, but we also like to look at the details because there may be some things in there. For example, if you sold some stock that the broker wasn't involved in your actual purchase of it, like maybe a stock plan that you got from your employer, the basis may not be exactly what it says on that report. Because if it was a type of stock plan that you paid income tax when that stock plan was given to you, you need to add that income to the cost of the actual purchase that you did of that employer stock. And that increases your basis, reduces your gain, and that is important. Long-term gains, by the way, you can see are taxed at 0, 15%, and 20%, unless you have over, I think for married filing jointly $600,000, you don't get above the 15% bracket on your capital gains. So, unless you're doing a lot of trading and you're doing very well, usually the maximum is going to be 15%, and actually 0% up to about 90,000, I believe. I need to double check on that. If you sell the stock within 1 year, you're going to be ordinary rates. And so, it'll be just like additional, W-2 wages, interest, and dividends. I put in there, ouch, that means crypto. Right now, the crypto reporting is what we refer to as the wild, wild west. It is out there. It is very sketchy. Next year, it's not going to be that sketchy, folks. It's going to be reported. I've seen the copies of the 1099-Bs, and I think there's a new 1099-DA, if I'm not mistaken, and the DA stands for digital asset, and that is crypto or whatever all these categories are. A lot of people are doing these things, and some we saw one this past year. I think Sean was working on that literally had several hundred crypto transactions. And we just said, contact the crypto, the broker that you use, let them give you the summary because it's crazy. And by the way, summaries are totally appropriate for reporting these items. You don't have to list the individual categories. Speaking of which, just to shorten this, there are other items where basis needs to be taken into account that is not going to show up on that. And that the most common one is a wash sale. Real quickly, I own a stock. It's lost a lot. I've made some gains. I want to sell that stock to what we call harvest that loss to offset against the gain. That's great. But you also say, God, I really like that stock and I really want to get it back. Well, you better wait at least 31 days before you buy it back. Because if you buy it back before that, IRS is going to say, no, no, no. It's like you never sold it. We're going to eliminate that loss for you. So let's be careful. Again, that's what you come to us for. Before you try to do anything, I hate to use this term, sketchy, but if you're thinking of sketchy things, come to us. We'll let you know if it has some merit or ways to do it, maybe that you can accomplish the same thing in an appropriate way. One last thing on the broker statement. That's why we want the whole thing. There's a lot of supplementary information at the back end of the statement. It will give us some information on maybe being able to exclude taxes from your state if it's government interest, or from your state, if it's tax exempt interest that is included in your state. So we look at all that thing. So I know it's a lot of stuff to scan and send to us. A lot of you are local, we're very welcoming. You can come in the front door and drop it off if you don't want to scan 50 pages, but it's important that we get it. And you're going to see we're going to ask for it. That's it. I'll see you in a few minutes or in a minute.
Yeah, they're going to see you in a minute because guess what? You're the next presenter on the estate and trust overview.
Okay. I've been a CPA for well over 50 years. Well, I actually am not because I'm not licensed anymore because I retired. Ha, ha, ha. I'm really retired, as you can see. But I've been doing this since the middle 70s. I was obtained my certificate in 1975. And so I'm old enough so I see where people are avoiding estate and trust discussions. A lot of people don't like to talk about, whoa, when I die, whoa, what's going to happen? But it's very important. You've worked a lifetime to accumulate things, and there are certain things that you need to focus on, and that's what estates and trusts are. It's a simple question that I said here. What am I going to do with my stuff? How am I going to preserve so the tax man doesn't get more than he's entitled to? And the best way to do it is to sit down with a team, financial advisors, insurance people, and of course, us, or whoever your tax advisor could be. You want to get a coordinated effort of wills, trusts, powers of attorney. These are very complicated but important things to do. It accomplishes several things. It accomplishes where this stuff is going to go. Who do I want to get what I have when I'm gone? This is called controlling from the grave. You're reaching out from the grave and saying, hey, I want you to do this. And it's laid out in your trust. Also, very important, if you don't have a will or you don't avail yourself and use your trust, and I'll talk about that in a moment, you have to go through probate. And there is a significant cost to probate. So that's another savings of why you do this. Yes, there's a cost involved in drafting these wills and trusts, but in the end, it's going to come back and help you. It's going to save you in proper planning for taxes. It's going to save you in proper planning, avoiding probate costs. And it's going to avoid, I've seen probate operate for many, many years. And as long as probate's open, operating, you're going to be filing trust returns while those assets are in probate and filing tax returns. And I'll talk about that. It's very expensive to retain income in a trust. There are various trusts. The common trust is one that allows you to do what you want to do. One of the more common questions we see people ask us each year is, I inherited money. Is it taxable? No. That's a real short, simple answer. No. However, if you are now a beneficiary of a trust and the trust is distributing income that it's earned while it is in the trust, and that gets distributed to you, then yes, you are going to pay taxes on that. And the reason why you might want to do that, and we will help you make that decision, is that trust taxes are very expensive. Just to give you an idea, and I had to write this down because my memory isn't as great as it used to be, but on the return that you file your trust, you quickly, above $12,000 generally, are in the 35% tax bracket. That's pretty harsh when, for, let's say, a married filing couple, they don't get into the 35% bracket until they're over 500,000 of income. So you want to monitor and make sure that you're not leaving a lot of income in your trust. And if it's capital gains, the same thing. Capital gains get to be at 20% at $16,000 instead of the $500,000 or so individually. So it's important that you work with us and we help you decide what you want to do. One last note, people devise all these plans and set up trusts, and they forget one thing, and that's putting the assets in the trust. Can't tell you how many times we see people have these trusts set up and they neglected to put not all their assets, the appropriate assets into their trust. please do that. We recommend you put everything in your bank accounts, your broker accounts, your real estate. Don't put in your personal property, your TVs, well, I have a big record collection, stuff like that, unless they're collectibles. The other thing, and again, this is all very personal and we really can't get into the details. IRAs, people think, well, I'll put my IRA in the trust. No, you can't. But you can make the trust your beneficiary. But there are certain rules that become very important and impacts the taxing on that. And I don't want to get into that because it gets very confusing. But be aware, these are great plans. Follow through on it. Make sure you transfer what you need to transfer. We want you to avoid probate costs, but we also want you to be able to direct where you want your assets to go. And that's a hard decision to come face to face with. I think that's it for estates and trusts. I've talked long enough today.
Well, let me just add, Fred, that North Carolina does not have an inheritance tax. So I wanted to just announce that because I think we have listeners that are in different states. Also, I know you and I talked. We've had situations where someone transferred a house to their dependent or person that would be inherited in. And we would have advised against that because of the step up in basis that happens when the owner of the house passes away. So it's really important. We want to partner with you in your estate planning. We are not estate planners. In North Carolina, you have to be an attorney to do that, but we can work closely with your attorney. We use Shelley Pennington at Family Law right here in town, but we can work with attorneys to help with the tax planning aspect of building your estate. So yeah, Fred, I
Yeah,
wanted to.
let me chime in on a second. The step up in basis. So if you had your house and it increased $1 million and you sold it, yeah, you could exclude 500,000. But as estate planners will say, well, the best way to avoid capital gain is die. Because the minute you die,
That's the best. That's only
it
way.
becomes what the value is that day. That's a
That is
harsh
true.
tax planning tactic to advise. But you use accountants to help you maybe figure out a way to avoid coming up and paying taxes on some of these gains. We don't want you dying. We want your
Right.
clients for a long time.
We want you to stay alive.
Okay, does that conclude that section? Because I'm not trying to die. So at this point, we're going to bring in the bookkeeping aspect of the business. We're going to have Andrew give a presentation on the importance of bookkeeping.
Thank you, Sean. Hello, everyone. My name is Andrew, and we're going to talk the importance of bookkeeping. But in order to start, let's talk about what bookkeeping is, and let's start with that with a simple illustration. So when you learn a new language, first you need to understand what the meaning of words for one, and also how to properly communicate those words to people you're trying to talk in that language. However, there's a system of rules and principles in order to guide you, in order to properly convey those words and be meaningful to the person you're talking to. Well, accounting has been known for quite some time as the language of business, and bookkeeping is that part of accounting that's the system that helps put the numbers together, that tells you what's the meaning of the numbers of your business and how you can and then once you know the meaning of the words, those numbers, it helps you convey those to not only any potential investors, creditors, but also to tax authorities as well. So that's why it's important for business owners to know the importance of bookkeeping. And throughout this presentation, we've stressed the importance of accuracy, and that's still true for bookkeeping since the tax preparers and CPAs very much depend on accurate bookkeeping. For starters, it's important that the business that your business revenues and expenses are what they are. For example, you need when it comes to your revenues, it's important that all the transactions that make up those revenues aren't duplicated, or is that they're not in actuality money that you were truly the owner was just contributing to the business or via financing. And now in terms of expenses, it's important that they are complete and correct. For instance, you may be having a vehicle or credit cards that you utilize in the course of your business operations. Now, payments to the loans of that vehicle or the credit cards themselves, those payments themselves are not expenses. And details like those, you want to be as accurate as possible in order for you business owners to make good, informed decisions, and especially when it comes to your company's growth. For instance, if you're a merchandiser, you may want to know what particular products are the ones that are generating the most profits for your business, or if you want to know if your company is in a good enough position at proving over the course of time that you want to expand your business. Now, when it comes to time, we all know, and though we don't like to accept that there's so many hours in a day, and you can only juggle so many balls in the air. So for that reason, it's important that business owners are efficient with their time so that they can focus on their operations. To that end, it's highly recommended that they entrust qualified bookkeepers that have the knowledge and the resources in order to ensure that that the business's record keeping is proper and complete. And it's just as in save time for for the business owners, it saves time also for the tax preparers and the CPAs involved when they deal with your tax returns. For example, and that's because that if your books aren't kept, and that causes that means that the tax team and CPAs are forced to rely on guesswork, and that can cause them to miss important business deductions, and that means also potentially higher taxes for the business owners. And so long story short, proper bookkeeping means less stress for everyone involved. Now, Mrs. Waldron mentioned before was talking about before estimated taxes, and those that pay that include those that are self-employed, which means business owners. So, in other words, a company's bottom line, their profits, are considerable taxable income to business owners, and be it that your business is an LLC, partnership, or corporation. So knowing how much profit is generated throughout the year can help you anticipate ahead of time how much you are going to be required to pay in federal and state taxes. We've seen oftentimes where a business owner comes to us to prepare their taxes. However, since their books aren't kept, it delays our tax team to be able to process their tax returns. Normally that comes with that we need to be sure that we get their books caught up before we can do their tax returns. So moral of the story is that proper consistent bookkeeping matters to you business owners because complete, reliable, and accurate books mean faster, cleaner tax filings for the business and personal returns. Thank you.
Thank you for that wonderful presentation. Business owners, record keeping, record keeping, record keeping. That is the motto for the day. Now, at this point, we're going to take a few questions. If we've had any questions in the comment section, I can read them out. and we can get somebody to answer them. Let's see. I do have a question here from Diana Cole that says, if you buy a vehicle every year, I can't see the rest of it. Hold on, give me a sec. If you buy a vehicle,
I think I saw that, Sean.
yeah,
She wants to know if the next year you can write off the next vehicle that you buy.
yeah, if you buy a vehicle every year, can you get 100% each year?
Well, yeah, but no, because if the next year you buy a new car, we got to do something with the old car, and it's called recapture. So you're going to recapture because the rules for all these, bonus depreciation stuff, especially for vehicles, have got to be over 50% use. So even if you don't sell the old vehicle, you give it to your child, it's retired from the business. You're going to recapture the depreciation that you took. So the answer is yes. The next year you buy a new car, you can do it again. But guess what? You're going to offset the recapture from the year before's car. So it's a great question, though, because I like the way you think. And my dad would like it because he was a car salesman.
Let's see, are there any more questions? I know someone had a question they were going to hold to the end. I don't see the question, but what we could do is, I know that Zoom has a raise hand feature. If somebody has a question they want to raise their hand, I can call upon them and we can see if we can answer your question. We'll take maybe 1 or 2 questions that way. If not, then I'm going to move it over to Akilah for some closing remarks. All right. So let's wrap this thing up. Akilah, if you have any closing remarks, you can give them at this moment.
Okay, well, before I go into the closing remarks, I want to just say, I want to kind of give a few more hot topics, things that I've learned under the One Big Beautiful Bill. Withholding tables are not changing in 2026. So you may think that your refund may be higher, but the bottom line is that you're going to pay, you may end up paying more taxes because inflation and everything will increase, but the withholding tables will stay the same. So you may have bonuses, and that may put you into the next tax bracket quicker than it would have been if the tables would have stayed, would have also, kind of adjusted as well. I want to also mention to the teachers, again, I think this is huge. It used to be $250 you can claim max, but I know teachers pay much more than $250. In 2025, the threshold is $300. In 2026, you get $300 as a before the line deduction, meaning that will decrease your adjusted gross income before itemizing, and anything that you spend in addition to the 300,000. If you spent, I'm sorry, $300. If you spent $1,000, you get to claim that as an itemized deduction if you're itemizing. And I think that's huge for teachers because I know that they spend a lot. And what a blessing I think it is. So I wanted to make sure to mention that. And we've already talked about the bonus depreciation, but not only on vehicles, it's machinery and equipment as well. Oh, one final thing that I want to mention for those business owners that research and experiment, that's called R&E, and I believe it's starting in 2025. It may have, or 2026. I can't remember which year, but you no longer have to depreciate that or amortize that over 15 years. You get to take it as one deduction in the same year, and it's dollar for dollar. I think that is huge. So if you are investigating or experimenting and researching for a product or a service that you're trying to do, capture those costs and let us know what those are, because you can claim that as a deduction against your tax. Okay, so I wanted to make sure that I mentioned that there's so many other things under this law that we have to get our minds wrapped around, because it's a lot.
Okay, thank you for participating. Thank you for all our presenters. Let's give them a big round of applause. I know can't see them, but I know you're out there and you're clapping for them. Thank you so much. Oh, there's the hand claps. I like that. Thank you so much for your time. We are grateful for you to participate in this, and we hope to see you come in and bring your taxes to us for service. Have a blessed day.
Thank you. Thank you, everyone.